as I'm recording this, the US fired back with 145% tariffs on select Chinese products. And China also indicated that they were prepared to fight to the bitter end and increased their tariffs rate on US goods, on some American goods, by 125%. In simple terms, a tariff is a tax on imported goods or services. So tariffs essentially are meant to protect domestic industries, but they are also a tool that can probably cause some trade tensions and lead to retaliations, as we are seeing now. So once there is instability there and there's instability in the stock market, then it becomes very difficult for investors to find which way to actually hedge their portfolios or to make money, at least in my view. So why is this happening? Because global investors are actually pulling out of the US market altogether. If you look at the bond market, there has been information that investors, they are nervous about where the global financial markets are headed. And the US used to be a good safe haven, even the US dollar as well. But this time, investors are seeing that the US is now at the epicenter of uncertainty because of the tariff hikes. Meanwhile, China might look to shift exports to Europe, Latin America, and other parts of Asia. Here is why this is key. The Federal Reserve Bank controls short-term interest rates, like the overnight lending rates. Even here in the Bank of Canada, that's what they do. They control the overnight lending rate. But the markets set the 10-year yield. So when investors sell the 10-year bond, the yield goes up. A weak dollar can hurt imports but help exporters, although tariffs complicate that. If China shifts trade elsewhere, the US could lose influence in the global market. So if you look at Japan, China, which held a lot of US Treasury bills, them selling, in other words, it's like, you know what, no thanks. It's a vote of no confidence, basically. This could reshape the global supply chains, affecting everything from iPhones to EV batteries. Tariffs are a tax on trade, and they ripple through the global economy. Stock, bond, and current market are currently really feeling the pain. The 10-year Treasury is a critical signal on long-term confidence.